Hey guys, so in this video I'm going to be going over 3 stocks that I think should be on everybody's watch list for January of 2018 and for the rest of the year. Now, these 3 companies I believe are going to be making major moves in 2018 because they've all been positioning themselves to take advantage of a growing global economy. Now, if you look at the current predictions from the Federal Reserve, both the United States, the European Union, and the Asian Pacific region are all going to be experiencing massive economic growth over the next few years. And if you really want to be able to capitalize on that growth, you really need to start looking in the companies that deal in all 3 regions. All right, so the first company on my list is IRobot. For those of you who don't know, iRobot creates the Roomba robotic vacuum cleaner and the Brava Jet robotic mopping unit. Now, over the past few years, iRobot has been experiencing massive revenue growth. It's been increasing its revenue on average between 25 and 30% a year, and that is just kind of outstanding for any company. Now, iRobot has secured its dominant role in both the European, American, and Asian marketplace, with having over a 60% market share in each of the corresponding regions. It is beating out companies like Samsung, LG, and Nidovac in all of these spaces because of its outstanding software and outstanding products that people just know that they will get quality off of once they buy it. Over the past couple of quarters, they have made 2 major acquisitions. They have acquired, both in Europe and in Japan, their #1 distributor. And looking down the line with what they were planning on is that now that they have these 2 distributors that they own, they now can significantly lower costs while increasing the amount of units they sell in both of these respected locations. So if you look at, say, for example, China's GDP growth is going to be looking at 6.5% in 2018 and then 6.1% in 2018, compared to the 2.5 and 2.3% growth that is expected out of the US. Now, iRobot is banking on other regions in the world having massive economic growth, and they have positioned themselves very correctly to do so. One of the great underlying things also about iRobot is the fact that it has a massive wall of patents. Now, using these patents, it has been able to kind of safely secure its market share by kicking out other companies that are trying to enter its market. For example, Stanley Black & Decker tried to introduce their own robotic vacuum cleaner this year, and it violated multiple iRobot patents. Now, iRobot was able to, one, secure some money off of this lawsuit, but it was also able to kick Stanley Black & Decker out of their individual market space for the foreseeable future. Over the next few years, Stanley Black & Decker cannot enter the robotic vacuum cleaning space. And iRobot, being such a small company, being able to just knock off companies like Stanley Black & Decker just because of its sheer wall of patents is kind of outstanding, and it provides it one of the best moats, per se, in this space, and why I think that iRobot is a pretty safe bet if you believe in the smart home in the foreseeable future. So the second company on my list is Caterpillar. Now, I'm sure many of you know about Caterpillar, and you've seen their trucks, their excavators, and many other building materials around, but they are right now the #1 play in infrastructure production in both the US and in China. Now, President Trump has proposed a $1 trillion bill that will directly be added into infrastructure development. Another thing to keep in mind when looking at Caterpillar is that we have been in a bull market for a very long time right now, and generally, the longer you stay in a bull market, the more focused governments get on building out their infrastructure. So this can be seen with both America and in China. China has actually had multiple economists go on different news sources and say that the Chinese government is not focused on growth like it has been this past year. The Chinese government wants to focus on lowering its overall consumer debt and really building out its infrastructure along with its energy and public transportation. This is really great for Caterpillar because Caterpillar is the dominant force that drives a lot of infrastructure building in China. This past year, they just had a massive contract for a few $billions coming from the Chinese government, which started to surge their stock price. And with the Chinese government right now publicly saying that they're focusing on building out infrastructure and really focusing on building out their country, it only means that more money is going to be coming down for CAT in the foreseeable future from China, along with the massive $1 trillion bill that could get passed in America, Caterpillar seems like a really, really safe stock in going forward. And the company also pays a 2% dividend, which is nice just as an extra boost for, really investing in for the long haul. The third and final stock on my list for the month of January is Facebook. Now, Facebook is kind of in a really good position right now because ad rates are going through the roof. Now, Facebook receives more than 86% of its revenue from advertisements, and the average cost per click is going up anywhere from 10 to 20% in the short run, let alone in the long run. Now, this means a massive amount of money is going to be getting pumped into Facebook's net income because their overall costs aren't changing, just the value of their product is going up. Now, 86% of Facebook's revenue comes from advertisements. Between Facebook and Google alone, they make up over 67% of the total digital marketing market. So Instagram, in recent polls, has been shown to be loved by both the consumer and businesses alike, mainly because the user rate on Instagram has been rebounded and has actually been re-accelerating its growth over the past couple of months. And businesses have been polled, and they all agree that the advertisements that you see on Instagram are the ones that they really want to be putting their money towards because they're the ones that generally have the most return on investment for them. And a lot of companies are actually switching to social media marketing now because it is by far the most cost-effective way to, you pay a few $1,000s here and you immediately hit, say, 100,000 users, 1 million users, things like that, as opposed to buying a billboard or a TV or a radio ad. So while it's extremely more cost-effective for the business, it's actually more effective. So a lot of businesses are shifting, especially starting out businesses, are really shifting into really focusing on social media marketing. Now, Facebook over the past couple of years has been experimenting with a smart learning and really getting to know their users from the use of AIs to take all of your habits, your spending habits, your search habits, and things that you like and dislike, and compile them all together, and then using that data, it's going to start recommending you advertisements accordingly. So this is great because it means that the longer that you use social media, whether it's through WhatsApp, Facebook, or Instagram, the more accurate it's going to know you, and the more accurate it's going to be able to recommend you advertisements, so that way it can charge an even higher rate for companies that are trying to advertise on its platform. Because generally, if you show an audience a specifically targeted ad, you're going to have a much better turnover rate, which means more money going directly into the business. So the business is willing to pay that higher rate because they know it's the best thing out there. Now, on a side note, Facebook also owns Oculus, which, while VR is kind of new and in its infancy and isn't really mainstream yet, Oculus right now is one of the biggest and best plays in the VR space. And without being able to directly invest in the majority of the companies, investing in Facebook is an indirect play on investing in VR, which in my opinion is going to be huge over the next few years, especially with, kids switching from, the generic console gaming and using a controller to really just switching into that full VR system and really getting fully submerged in the content. Because I'll tell you, I've used a few VR simulators before, and it's kind of groundbreaking going from, like, say, an Xbox to VR. It's totally different, and I think it's going to be a huge industry in the future. So that's it for the 3 stocks I recommend for the month of January. I hope that you guys found use out of this, and that you were able to, look at these companies in a light that you didn't initially think of, or maybe even introduce to you a couple of great companies. If you guys have any comments or concerns or anything, just make sure to throw it down in the comment section below. If you enjoyed this content, give me a like. If you didn't, give me a dislike, so that way I can get some feedback and really, tailor my videos in the future. So yeah, hope you guys got some use out of this. See ya.